Welcome to the May 11th, 2020 Advance Report from McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman with your fast-paced tour of the global financial markets. Yes, we usually start with the Dow chart, and we will this week too. The end of today's broadcast, I have unraveled the mystery of negative oil prices, or at least part of it, from last month and the implications going forward. Well, let's start with the Dow. There is your high above 29,500. There is the apex of panic, March 23rd, about 18,000 on the Dow. This week holding 24,000 at the end of the week. In the face of the worst jobs news in history, there are 33 million people that filed for unemployment, 20.5 million, according to the Bureau of Labor Statistics, the reduction in non-farm payroll. The difference between those two we're researching. But April was a shutdown tragedy. It was depressionary levels. May, on the other hand, as you start to look forward, we have anecdotal evidence of people returning to work that had filed for unemployment, and we'll bring you more intelligence on that. Obviously, this is more forward-looking than this right here. This was your worst case, the current settling out at 24,000, and you've established a new range that's likely between 21,000 and 27,000 on the Dow. It took the S&P and the Dow 7 years to recover after the tech wreck. It took them 5 years to recover after the 2008-2009 crisis. This one is likely to be a 3 to 5 year slog to get back to that level. So what do we do as investors? That's why you tune in to YouTube McGowan Group each week. Be sure to subscribe. Okay, forward GDP forecast tells part of the story, and then we'll get to earnings. This quarter, because April was shut down, a minus 28% on GDP, a minus 5 last quarter for the partial shutdown in March. That's the damage survey. Here's the projection. A 10% bounce back, 9.5% for the Bloomberg consensus in the third quarter. Some have said that bounce back could be near 20%, and that's what we're going to monitor going forward. 7% for the fourth quarter, 5% for the first quarter. On this trajectory, it means that the Dow Jones Industrial Average, that range is probably set for a while, and it is probably 2023 before the U.S. economy reaches record levels above where it was in January just a few short months ago. This projection is year over year. It shows a minus 4% for the United States, and then a recovery of over 3%. Those numbers have come back down, so minus 4 and almost a plus 4 here, and then a continuation of that 2.2 to 2.4% that we saw. Well, those projections are going to be wrong because they're projections, but to what direction? And I think next quarter, the third quarter, it's likely to be much better than expected. Here's one of the reasons why. This is the forecast for S&P earnings. How much do these 500 companies make net after tax as a basket, right? Like the spiders that trade on the exchange. And this says it is the second half of 2021 before you return to record profit levels. That could be optimistic. There's also a projection that it goes up to more than 10% where it was back in 2018. You can see what happened to earnings that drove the 2018 short bear market cycle, the recovery in 19, but now, bam, a reduction of about 30% in those earnings, which appears to be coming true in the current reports. All right, what are solutions? We've added medical dividend companies to the portfolio because they corrected hard here. We started adding somewhere in here, and the medical dividend companies are probably, this is the healthcare sector for the S&P, by the way. There's a permanent benefit, I believe, in the medical field that we haven't seen before, and that is an attention to research, development, an encouragement by tax policy but the investment that cities and states, hospitals, and doctors will make going forward in virus prevention obviously is going to be higher. And even what each of us does in terms of elective medical, whether that's strengthening through elective choices, there is a big focus on medical for a good reason going forward. Now, this was our strategy for 2008-2009. It is our core strategy right now. We've covered it in a few of the previous broadcasts. These are two example, one global, one US, B-rated bond baskets. C is distressed. B is average. A is investment grade. AAA, of course, is treasuries. So this part of the fixed income market makes sense because you get paid to wait. What you can see here, 2007 through 2012, is the total return for two baskets of bonds, basically B-rated bonds. Huge defaults expected in 2008. That was really not the case. The default rate went to 10%, but it didn't go to what this reflected. And that was about a 50% reduction in price. You could buy baskets of bonds for half price. At that point, paying 15%, on the worst day, 21%. We scooped those up, we reinvested. We also had some coming into it. You'll notice the recovery there wasn't 5 to 7 years. It was by the end of 2009. Why? Bonds and loans mature at par if the issuer can pay. The Fed and the Treasury have done the right things to prevent defaults. Only the C-rateds that were expected to default in retail, restaurants, and energy, only the C-rated are in the most danger right now based on the current reports that we're seeing. But reinvested for that 5 years, global high yield, 14% average return with a recovery much faster than equity. And you got paid to wait. You get real interest every month. And look at here. Look at this. You have the B-rated basket of U.S. bonds. Average return near 10%, just below 10. Reinvested for that 5 years. The strategy wasn't decimated, but the prices were at bargain levels, and you could gain advantage through reinvestment and speed that recovery. That's part of the strategy as well. Medical dividends plus right here, we've got the global high yield and domestic high yield. And what's the other core part of the strategy for those that can understand price risk and owning great assets? Well, it's energy. And I wanted to cover something about the energy markets because oil went to a minus 37 last month. For the first time in history, you paid money to store oil, to put oil somewhere. And there was a factor that I want to cover here. This is a longer term chart. And we look at oil versus the price of one of the best pipeline companies. The pipelines traded as low as 80% of the value of the steel in the ground, according to our reports. That's absolutely huge. In other words, they were just giving away the pipelines. Reinvesting those dividends, those great assets will still be there, and those companies appear to be well prepared for crisis because they had paid down debt, raised dividends, built up some cash. There'll be some selective dividend cuts. What happened at minus 37 oil? That's what I promised you. I'm going to tell a fictional story about the Bank of China. Fact. The Bank of China issued oil certificates. Now we get to the story. So let's say Hung Zhu with 8 kids is saving money as an executive, probably well advanced in the Chinese Communist Party, but a business executive making good money. And let's say he has a college fund and decides to put $10,000 in Chinese oil certificates. Hung Zhu thinks he's buying oil, okay? Puts the money in. Hears about how bad the pandemic is globally, and he realizes what that's going to do to the economy. Calls his broker and says, sell it. Broker calls him back in 3 days, and this is what happened last month, and says, you owe $12,000. He said, wait, no, I had $10,000 in oil. Where's the oil? He says, well, your settlement was a minus $12,000. You owe us a check right now for the Bank of China. He's like, oh my God. So he calls his buddy, fictional story, calls his buddy, Hang Yu, over at the Bank of China. And this is what actually happened in those certificates. finds out that Hang Yu, the fictional commodity trader, somebody at the Bank of China, we'll just name him Hang Yu, decided each month that he wouldn't buy the oil or store it, he would just buy the West Texas Intermediate crude futures. And then once a month, he would roll it to the next futures. So the price looked like the price of oil. Well, guess what? Storage was nearly full. And the pipelines and the storage companies were charging big money to store oil. So Bank of China calls up to roll their contract. They can't. That's apparently what happened. So the Bank of China says, we don't care, we have to sell it and roll it because we can't take delivery because we're in China and West Texas is in West Texas. Well, boom, Hang Yu puts in his sell order. That cascaded down to minus 37 a barrel, and poor Hang Yu has to send in a check. That's to give you an understanding of what happened last month with negative oil prices. Is it a great opportunity? History shows us likely so. This is one of the great oil busts and opportunities, but for those that own great infrastructure assets, this could be the opportunity of a lifetime. I'm Spencer McGowan, President, McGowanGroup, and your financial weatherman. Thank you for joining us. Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President, McGowanGroup, your financial weatherman. We sponsor each week NetWorthRadio.com broadcast that has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast-breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as NetWorthRadio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who are devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to NetWorthRadio.com, the McGowanGroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of 02, 08, 2018, and the recoveries through the most recent quarter. That is true education of investors and exactly how our clients have done, disclosed right here. Further disclosures, value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast. And that can actually work to your advantage. We'll build that into your plan. So I urge you to go to NetWorthRadio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast or any securities doesn't make it a recommendation for your portfolio until you have that written plan. Thank you for tuning in today, and we'll be back next week as your financial weatherman.